You know that feeling when you're at a party where everyone is laughing, drinking champagne, celebrating insane profits, and you're the only one who notices the building is on fire? This is exactly how I feel now, in January of 2025. And it's not paranoia. It's standard. I've spent 45 years of my life studying financial collapses, and there's something happening now that is so bizarre, so statistically improbable, that I've only seen it twice before. And both times, what came next destroyed fortunes that had taken decades to build. Let me give you a number that should make you stop everything you're doing right now. The correlation between all asset classes reached 92%. 92. Do you understand what this means? It means that stocks, bonds, real estate, commodities, everything is moving in the same direction at the same time. The last time this happened was in August of 2007, 8 months before the collapse that vaporized $56 trillion in global wealth. Before that, September 1987, 2 months before Black Monday. And now it's happening again. But there's something worse, much worse. The spread between what hedge funds are betting and what institutional investors are doing is the biggest since we started tracking it in 1998. Someone is terribly wrong. And based on 5 decades of navigating markets, I know who is usually wrong in these moments. Institutions are not the ones who manage pensions for millions of people. It's the 6.2 to 1 leveraged hedge funds that need to be right now, or they blow up. And when they explode, they take everything with them. If you're not already subscribed to this channel, subscribe now, because over the next few weeks, I'm going to show you exactly which positions are most vulnerable, which sectors will bleed first, and most importantly, how you position yourself to not only survive, but profit when that correlation breaks down. And it will break. Mathematics guarantees this. Let me show you something I learned from managing $160 billion through 2008. When correlations rise above 85% for more than 90 days, the market is pricing in a scenario where only one outcome is possible. He is saying that everything will work out or everything will go wrong. There is no middle ground. It's binary. And markets that think in a binary way are always wrong. Why? Because the world is not binary. The economy is not binary. Individual businesses are not binary. When the market acts as if they are, it's because it stopped doing fundamental analysis and started doing flow analysis. It's just following money, not value. And this is exactly the setup we have seen before every major correction of the last 50 years. Now let me give you the second sign that's keeping me up at night. And this one is even more ominous. The volume of options expiring in 0 days, what we call 0 DTE options, has exploded to represent 43% of all S&P 500 options volume. 43%. Let me translate this into clear Portuguese. Almost half of all bets in the world's most important market are being placed by people hoping to know whether they won or lost before the sun sets. This is not investment. That's not even trading. It's roulette with a facade of sophistication. And when you have this level of very short-term speculation dominating price discovery, the market completely loses connection with economic reality. Prices stop reflecting the fundamental value of companies and start reflecting only the next tick, the next gamma squeeze, the next wave of momentum. At Bridgewater, we have a principle that I learned the hard way in 1987 when I lost 4% in a single day. The principle is simple. When short-term speculation dominates price formation, prepare for violence. Get ready for 10, 15, 20% moves that happen in days, not months. Because when everyone is making the same bet with leverage on the same side of the trade, the exit becomes very, very narrow. And I want to know from you, where are you watching this video from? Leave a comment telling me your city and country, because these patterns I'm seeing are global, not just American, and I want to understand who around the world is paying attention while the majority are completely hypnotized by narratives of artificial intelligence will save everything and soft landing is guaranteed. The third sign that concerns me is about corporate debt, but not in the way you are thinking. Everyone talks about the absolute level of debt, which, yes, is at 186% of GDP, greater than 2007. But the real problem is not how much they owe. That's when they need to pay. In the next 18 months, $450 billion of BBB-rated corporate debt matures. BBB is the last step before junk. And here's what no one is talking about. These companies borrowed this money when interest rates were 1%, 2%. Now, they will have to refinance at 5.5% or 6%. Do the math. A company that was paying $10 million a year in interest will have to pay $25 million to $30 million. Where does this extra money come from? Layoffs, investment cuts, sale of assets. Each of these actions slows down the economy. And when $450 billion worth of companies are doing this at the same time, that's no headwind. It's a hurricane. But wait, it gets worse. Regional banks that lent $300 billion of that $450 billion are sitting on unrealized losses of $520 billion on their bond portfolios because of rising interest rates. So they have no appetite to refinance these companies on friendly terms. They will tighten. They will require additional collateral. They will force harsher terms. This creates a feedback loop where companies that could survive with normal refinancing are pushed into distress. And distress in BBB companies infects markets. It infects banks, contains confidence. The fourth signal comes from a place that few are looking at, but that always signals problems before they appear in headlines. It's the repo market, the market where banks lend money to each other overnight using treasuries as collateral. In the last 3 months, the spread between repo rate and Fed funds increased from 5 basis points to 28 basis points. It may seem small, but it isn't. That's an increase of 460%. And that means only one thing. Banks are starting to distrust each other. They are starting to price counterparty risk. And when banks price counterparty risk, it's because they know someone in the system is sitting on something rotten. They just don't know who he is yet. This is exactly what happened in June of 2007. Bear Stearns still had an investment-grade rating. Lehman was reporting record profits. But in the repo market, spreads began to widen. Why? Because traders who actually move money every day, who look at collateral line by line, started to see assets that didn't make sense, mortgages that failed to be appraised, CDOs that no one wanted to play, and they started charging more to accept this garbage as collateral. 7 months later, Bear Stearns imploded. 15 months later, Lehman disappeared. Today, repo spreads are screaming the same thing. Someone is holding something toxic. And when we find out who, the contagion will be quick and brutal. And the fifth sign, the one that scares me more than all the others, is behavioral. It's about trust, not retail confidence, which is always wrong at the extremes, but trust from family offices and ultra-high net worth. These are the guys who manage $5 billion, $10 billion, $20 billion. Guys who survived 4, 5, 6 crises. Guys who don't need to perform to keep a job. They can just leave and wait. And in the last 6 months, 15 of the largest family offices I know personally have increased cash and gold positions from an average of 12% to 38% of their portfolios. 38%. These guys don't do this out of irrational fear. They do it because they've seen this film before and know how it ends. One of them told me in December, and I will quote directly, "The problem is not whether there will be a crisis. This time, no one has dry gunpowder to put out the fire. Central banks have already used all the bullets. Interest rates cannot go negative again without crashing the financial system. BC balance sheets are already bloated with trillions that they cannot sell without crashing bonds. Governments are already in debt at 120% of GDP, some much more. So when the next crisis comes, and it will come because debt cycles don't lie, who will bail out? Answer: nobody. You will be on your own. And that, my friend, is why I'm making this video now, in January 2025, while there is still time to act. Now let me tell you two stories that will illustrate exactly the cost of ignoring these signs when they appear all together like this. The first story is about a guy I'll call David. He's not a Bridgewater client, but I know him through investment circles. By 2006, David had built a net worth of $45 million. I had done this for the past 25 years by building and selling 3 software companies. Smart guy. Disciplined. He wasn't a gambler. But in 2006, he started seeing the exact same patterns I'm seeing. Showing now. Banks offering mortgages to anyone. Correlations rising. Everyone making money. And he got nervous. So, in April 2007, 18 months before the bottom of March 2009, he liquidated 80% of his stocks and bought treasury bonds and some gold. His friends thought he had gone crazy. His wealth manager begged him not to do it. "You will miss the rally," they said. "The market will rise another 40%, they said. And for 8 months, they were right. Market continued to rise. S&P 500 went from 1,420 in April 2007 to 1,565 in October 2007. David lost 10% gains. His friends got another 10%. They made fun of him at dinner parties. They called him a doomsayer. But then came November of 2007. December. January 2008. Bear Stearns in March. Lehman in September. In March of 2009, when the market bottomed at 666 points, 56% below the peak, David still had 36 million intact. Your friends? The one who had 40 million had 18. The one who was 30 was 13. He who was 75 was 32. And here's the part that really matters. David used that 36 million to purchase quality assets in March and April of 2009 at fire sale prices. Companies paying dividend yields of 8, 9, 10%. Class A commercial properties at 50 cents per replacement cost dollar. Today, in 2025, that portfolio of 36 million turned into 220 million. His friends who held him back? They recouped their losses, of course. Market returned to peaks, but they started from a 56% smaller base. So that guy who was 40, even after the whole rally from 2009 to 2025, has 82 million today. David is 220. The difference? $138 million. All because he acted 8 months early, absorbed 8 months of jokes and ridicule, but was positioned when the world fell apart. The second story is institutional but equally brutal. In 2006, there was a state pension fund, I'll omit which state, that managed $110 billion for pensions for teachers, police officers, firefighters, people who worked 30, 40 years hoping to receive that money. The managers of this fund began to see signs of stress in the real estate market in mid-2006. Subprime defaults starting to rise. Credit spreads starting to widen on mortgage-backed securities. They brought in external consultants who recommended reducing exposure to financial companies from 62% of the equity portfolio to 40% and increasing cash from 5 to 20%. But the fund's board, made up of political appointees, didn't want to do that. Why? Because in 2006, finance companies were the top performers. Banks, brokers, insurance had risen 38% year to date. Reducing exposure would mean losing performance. It would mean being questioned by stakeholders. It would mean explaining why they left 38% gains on the table. So they didn't do anything. They kept 62% in financial institutions. They kept 5% in cash. And when 2007 became 2008, that portfolio imploded. Citi dropped from $55 to $10. Bank of America from $54 to $3. Lehman went to $0. Bear Stearns went to $0. Washington Mutual went to $0. Wachovia had to be rescued. That $110 billion pension fund fell to $48 billion in March of 2009. Loss of $62 billion. And consequences? 23,000 retirees had benefits cut between 15 and 35% permanently. Thousands had to go back to work at the age of 65 or 70. Some died while still working because they could not afford to stop. And all because managers didn't have the courage to act when signs were obvious. They were afraid of losing short-term performance. They were afraid of looking stupid if the market continued to rise. They preferred the risk of catastrophe to the certainty of criticism. This is what fear of missing out combined with career risk does to financial decisions. Kills wealth. It destroys futures. And it's happening now again in January of 2025 with pension fund managers, endowments, even sovereign wealth funds who are seeing the same signals but can't act because, what if we're wrong? What if it's different this time? What if we miss the AI rally? I understand this paralysis. Serious. It's human. But understanding doesn't change mathematics. And the math of long-term debt cycles doesn't care about your fears or hopes. So here's the framework we use at Bridgewater to navigate exactly those moments where signals are mixed, where part of the market is rising while fault lines are opening below. This is what we call balanced all-weather for 4 economic environments. It's not about predicting which environment will dominate. It's about being prepared for everyone. Environment 1 is growth accelerating with low inflation. This is the Goldilocks. Shares love. Corporate bonds love. Credit loves. But it only works if growth really accelerates and inflation is contained. Environment 2 is growth accelerating with inflation rising. Commodities love. Inflation-protected bonds love. Energy and material shares love. But long-duration bonds bleed. Environment 3 is slowing growth with low inflation. This is recession. Long-duration treasuries explode upwards. Gold goes up. Shares fall. Credit catches up. Environment 4 is the worst. Growth slowing with high inflation. Stagflation. Commodities are okay. Gold is king. Stocks catch up. Bonds get beat up. Credit dies. The problem is that at any given moment, you don't know which of these environments will dominate in the next 12, 18, 24 months. So what do most investors do? Bet. Choose a base scenario. Position the entire portfolio for that scenario. And twist. We do it differently. We build a portfolio where each environment has assets that perform well in it, balanced not by dollars, but by risk contribution. It means that if any one of the 4 environments dominates, we won't hit a home run, but we won't be destroyed either. And in moments like now, where signals are conflicting, where part of the economy is hot, but fault lines are appearing, this approach saves you. In 2008, while hedge funds on average lost 19% and the market lost 56%. Our all-weather was 3.8% positive. Not because we predicted Lehman would fail in September, not because we knew AIG would need bailing out, but because we were positioned for any environment. When credit collapsed, our long-duration treasuries rose 32%. When commodities plummeted, our short exposure to energies helped. When the dollar strengthened, our dollar positions benefited. None of these positions individually saved the day, but the combination, balanced by risk, allowed us to not only survive, but thrive while the world burned. And that's exactly the kind of positioning you need now. No massive directional bet, but real protection against the four possible environments. So let me give you 7 specific actions you can implement over the next 30 days to build that protection. It's not theory. This is what really works when correlations break and markets go into panic mode. The first critical action is to rebalance your portfolio from concentration to true diversification. And when I say true diversification, I'm not talking about having 60% S&P 500 and 40% aggregate bonds. This is not diversification. It is an illusion of diversification. Why? Because when correlations rise to 92%, like they are now, stocks and bonds fall together. It happened in 2002. It happened in 2022. It will happen again. Real diversification means having 15 different sources of return that don't move together. American stocks is one source. Long-duration treasury bonds are another. But you also need gold, commodities, inflation-linked bonds, emerging market stocks with low correlation to the S&P, foreign currencies, volatility strategies, trend following. Each of these is an independent source of return. And here's the crucial part. You don't balance by dollars. Balance is by risk contribution. It means you don't put 10% on each. You calculate how much risk each asset brings and balance it. Gold has 18% volatility per year. Long-duration bonds have 9%. So to have the same risk contribution, you need twice as many bonds as gold in terms of dollars. Do this exercise for all 15 sources. The goal is that if either one blows up or plummets, it doesn't kill or save your portfolio by itself. In 2008, investors who only owned stocks and corporate bonds were obliterated. 40, 50, 60% fell. Investors who had this balance of 15 sources? They fell 8, 12%, and recovered in 6 months. The difference is the difference between losing years of accumulation and just having a bad year. Practical implementation. Get a spreadsheet. List all your current positions. Calculate 3-year historical volatility of each asset. Multiply volatility by allocated value to have absolute risk contribution. Add it all up. Now divide each risk contribution by the total. This gives you a percentage of risk coming from each source. If 80% of your risk comes from S&P 500, you are massively concentrated. The goal is to have no more than 10% risk coming from any single source. Critical warning. When you rebalance like this, it will feel strange. It will look like you are selling your winners and buying losers. And in the short term, it may be true. Stocks may continue to rise for months while you reduce exposure. But remember David, he absorbed 8 months of underperformance, but saved and multiplied his fortune. The pain of rebalancing early is temporary. The pain of not rebalancing is permanent. The second protective action is to build a core position in physical gold, not ETFs, not miners, not gold futures. Physical gold that you directly control. And I know what you're thinking. Gold does not pay dividends. Gold does not generate cash flow. Gold is barbarous relic that Keynes criticized. All true. And all irrelevant when the monetary system is under stress. Let me explain to you why. Gold is not an investment. It's insurance. It is the only asset in the world that is not anyone's liability. Your action title is a claim against the company. Your bond is a claim against the government or corporation. Your money in the bank is a claim against the bank. Your dollar is a claim against the Federal Reserve. All of this is a promise of someone paying you something in the future. But gold? Gold is just gold. It doesn't depend on anyone to honor their promise. It does not depend on any government being responsible. It does not depend on any bank being solvent. It has been value in itself for 5,000 years, and will continue to be so for another 5,000. When the banking system crashes, as it did in 2008 when banks stopped lending to each other, gold retains value. When governments print trillions, as they did in 2020, 2021, gold maintains purchasing power. When confidence in fiat currencies collapses, as it did in Zimbabwe, Venezuela, Turkey, Lebanon, Argentina, gold is what saves families. And we are getting close to a moment where confidence in the dollar as a reserve currency can be seriously tested. China is de-dollarizing trade with Brazil, Russia, Saudi Arabia. BRICS is discussing alternative currency. The Fed has $8.5 trillion on its balance sheet that it cannot sell without crashing bonds. American debt to GDP is at 123%, a level that historically forces countries to choose between default or inflate away the debt. None of these options are good for holders of dollar-denominated assets. But gold holders? They just transition to the next monetary regime while maintaining purchasing power. Practical implementation. Allocate between 10 and 15% of your liquid portfolio in physical gold. Not 20, not 25, because gold has high volatility and you don't want to have to sell gold in the fund to cover expenses. But 10 to 15 is enough to protect without dominating. Buy bars or coins from reputable sources. Perth Mint, Royal Canadian Mint, Credit Suisse, PAMP. Store in secure vault service. Brinks, Loomis, or banks that offer allocated storage. Not commingled, allocated. It means that those specific bars are yours, not shares in a pool. A common mistake is to buy gold miners thinking it is exposure to gold. It is not. Miners are businesses with operational costs, debt, management risk, regulatory risk, strikes, accidents. Physical gold has none of that. Or buy ETFs like GLD thinking it's as good as physical. It is not. GLD gives you claim on gold that is in the vault. But in a real systemic crisis, do you think you will be able to redeem these shares and receive physical bars? Good luck. Physical gold allocated in your name is the only way to be sure that when you need it, it will be there. Consequence of not having gold? In 2008, it was not so critical because it was a credit crisis, not a crisis of confidence in currency. Fed managed to stabilize. But next time? What if there is a crisis of confidence in the treasury market, in the dollar, in the ability of governments to honor promises? Gold is going to be the only asset, besides maybe Bitcoin, that holds real value. And you will be rushing to buy at $2,800, $3,000, $3,500 an ounce, while those who bought now at $2,050 are protected. The third essential action is to build a much larger cash buffer than you think you need. And I'm not talking about 3 months of expenses. I'm talking about 18 to 24 months of expenses in cash, or ultra-safe cash equivalents. Why? Because in crises, cash is not just downside protection. It's ammunition to take advantage of opportunities that appear when everyone else is forced seller. Let me tell you what happened to me in March 2009. Bridgewater had substantial cash positions because we had reduced risk at the end of 2007. When the market bottomed out and panic was at its peak, blue-chip companies were being sold at valuations that didn't make sense. Johnson & Johnson, a company that sells diapers, Band-Aids, Tylenol, products that people buy in any economy, was trading at 7 times earnings. 7. Today, it is 22 times. Coca-Cola was at 11 times. Today, it is 27 times. Procter & Gamble was 9 times behind. Today, it is 25 times. If you had cash at that time, you could buy world-class companies that paid dividend yields of 5, 6, 7% at prices that guaranteed doubles and triples in the next 5 to 7 years. But here is the brutal reality. 93% of investors did not have cash available in March 2009. Why? Because they spent all their cash trying to average down their positions while the market fell from October 2007 to March 2009. They bought at 1,300 points in the S&P 500 thinking it was the bottom. Then they bought in 1,100 thinking that now it was the bottom. Then they bought in 900 thinking it was impossible to fall any further. And when it reached 666, the real bottom, they had nothing left. They were dry. Or worse, they were receiving margin calls and being forced sellers at exactly the worst possible moment. Who had cash? Buffett did. Bought $5 billion in preferreds from Goldman Sachs. Bought $3 billion from GE. Terms that gave you 10% dividend yield plus warrants that multiplied value. Today, these positions generated more than $15 billion in profits. David, from the first story, had it. He bought it in March and turned $36 million into $220 million. Family offices I mentioned, which increased cash to 38%, they will have it. You need to have it. Practical implementation. Calculate your monthly essential expenses, not inflated, essential lifestyle. Housing, food, utilities, insurance, healthcare, children's education if applicable. Multiply by 24. This is your cash buffer target. Build this in phases over the next 3 to 6 months by selling positions that have had big runs and you don't have high conviction. Where to store? 50% on 3 to 6 month Treasury bills. Rate is now at 4.5%, practically risk-free. 25% in systemically important bank savings account. J.P. Morgan, Bank of America, Wells Fargo. No regional banks. Systemically important means that the government will not let it go bankrupt. 25% in literal cash, physical cash, in a safe in your home. Sound paranoid? Perhaps. But in 2008, there were days when ATMs at some regional banks ran out of cash. There were days where people were unable to withdraw. Cyprus, in 2013, confiscated 10% of bank deposits above 100,000 euros. Greece limited withdrawals to 60 euros per day. Physical money ensures that you always have access regardless of what happens in the banking system. A common mistake is to think that a home equity line of credit or brokerage margin counts as a cash buffer. It doesn't count. Why? Because exactly when you need this liquidity most, in a crisis, banks cut your lines. They freeze credit. Requirements increase. Or worse, call the loan. This happened in 2008. People who had HELOCs of 500,000, 300,000 woke up one morning and got a letter saying line was reduced to 0. Banks have the contractual right to do this when they perceive an increase in risk. So HELOC is not a buffer. It's a buffer mirage that disappears when the fog of crisis arrives. Real cash, under your direct control, is the only way to ensure that when opportunity or emergency arises, you can act. The fourth protective action is to rebalance the duration of your bond portfolio from short-term to long-term. And I know this goes against everything you're hearing right now from wealth managers and analysts. They are saying, stay in short duration because the Fed can keep interest rates high for longer. Long-duration bonds will continue to suffer if this happens, and they are right about the short-term risk. But they are completely wrong about the risk of crisis. Let me explain the math of protection to you. When a crisis comes, when the stock market drops 20, 30, 40%, what happens? Fed cuts interest rates dramatically. Always. Always did. Always will. In 2001, it was cut from 6.5% to 1%. In 2007 to 2008, it cut from 5.25% to 0. In 2020, it fell from 1.75% to 0 in 3 weeks. 3 weeks. When the Fed cuts interest rates, what happens to the price of long-duration bonds? Explodes upwards. Why? Because bond prices move inversely to yields. When yields fall, prices rise. And last ion measures sensitivity. A 15-year bond rises approximately 15% for every 1% drop in yield. So if you are in a 20-year treasury with a duration of 15 and the Fed cuts interest rates from 5% to 3%, a 2% cut, your bond goes up 30%. 30. While your stock portfolio is falling 20, 30, 40%, this long-duration position is rising 20, 30, 40%, partially or completely offsetting the losses. This is what saved all weather in 2008. Our position in long-duration treasuries rose 32%, while equities plummeted. Without this, we would have lost 15 to 20%. With that, we made 3.8 positive. And here's what most don't understand. You don't buy long duration to make money in a normal environment. You buy for asymmetric crisis protection. During normal years, long duration will underperform short duration by 1, 2, 3% per year. Painful, but manageable. But when crisis comes, that position can do 20, 30, 40%, while everything else bleeds. This is the asymmetric payoff you are buying. Practical implementation. Look at your current bond allocation. If everything is in short duration, 2 years or less, or in bond funds that have an average duration of 3 to 5 years, you are exposed. Target should be an average duration of 10 to 12 years in your bond portfolio. How to do this? Sell short-duration bonds or short bond funds. Buy TLT, iShares 20-plus year Treasury Bond ETF. Or buy 20 to 30-year Treasuries directly from Treasury Direct. Allocate 25 to 30% of your fixed income portfolio to this. Not all of it, because if the Fed really keeps interest rates high for another 2-3 years, you will suffer a mark-to-market loss. But 25 to 30 is enough to give you significant protection if a crisis comes in the next 12 to 18 months. Critical warning. Long duration is protection, not speculation. It's not a bet that interest rates will fall next month or next quarter. It's insurance that when a crisis comes, you have something that rises while everything falls. So don't look day by day if you're gaining or losing 1 or 2%. You only care about performance when a crisis comes. Until then, it's insurance costs. Consequence of not having long duration: if a crash comes and you are 100% in the short duration or money market, you have nothing going up while equities collapse. You will see your portfolio drop 20, 30, 40% without any offset. And recovery will take 3, 4, 5 years instead of 12 to 18 months. The fifth essential strategy is to reduce leverage in whatever form you have in your portfolio. And when I say leverage, I'm not just talking about margin loans at the brokerage. I'm talking about a mortgage that's too big relative to your income, a home equity line that you used to invest, a business loan that depends on revenue continuing to grow, Any debt that forces you to make fixed monthly payments, regardless of what happens to your income or assets. Why? Because leverage is an amplifier. Amplifies gains when everything goes well, but it amplifies losses when everything goes wrong. And the real problem isn't even amplified loss. It is forced selling that leverage creates. Let me give you a concrete example. Let's say you have $1 million in your investment portfolio. $500,000 is your capital. $500,000 is a margin loan from the broker at a rate of 8% per year. Everything invested in shares. Market drops 20%. Your portfolio goes from $1 million to $800,000. You still owe $500,000. So your equity is now $300,000. Your leverage, which was 1-to-1, 50%, is now 1.67-to-1, 62.5%. Broker sends you margin call. You need to deposit $150,000 in cash or sell positions to reduce the loan. You don't have $150,000 in cash because you didn't follow action number 3. So you are forced to sell. And when do you sell? At the bottom of the 20% drop. You crystallize permanent loss. Market recovers 3 months later. You missed the recovery because you sold low. This is the leverage killer. It is not the mark-to-market loss. It is forced selling that transforms a temporary loss into a permanent one. In 1987, the Black Monday crash was amplified by portfolio insurance strategies that were essentially synthetic leverage. When the market started to fall, these strategies forced automatic selling, which caused more falling, which forced more selling, a feedback loop that led to a drop of 22.6% in one day. In 2008, hedge funds leveraged 4, 5, 6-to-1 were forced sellers when prime brokers increased collateral haircuts of 20 and for 40, 50% overnight. They had to liquidate good positions along with bad ones just to meet margin. Hundreds of funds closed not because they had unsustainable losses, but because they did not have the liquidity to meet calls. Now think about today's context. Hedge funds are leveraged on average 6.2-to-1, an all-time high. Private credit funds have leverage built into the companies they finance. Retail investors used margin at record levels in 2021, and many still carry it. When the next crisis comes, there will be a wave of forced selling from all these players at the same time. And who will be on the other side buying? Who doesn't have leverage? Who has cash? Those who have liquidity to absorb while leveraged are forced sellers. Practical implementation. Completely audit all debt you have. Mortgage, car loans, HELOCs, margin, business debt. For each, calculate fixed monthly payment. Add it all up. Now compare this to your net monthly income after taxes and essential expenses. If your debt payments are more than 20% of this number, you are over-levered. Target should be 10 to 15% at most. How to reduce? Start by paying off higher-cost debts first. Margin loan at 8%. Pay. HELOC at 7%. Pay. Car loan at 5%. Depending on your tax situation, you might keep it because interest rates are low, but if it makes you nervous, pay it off. Mortgage at 3.5%. This can stay if it is a fixed rate of 30 years and payment is comfortable. A common mistake is to think that because you can make payments comfortably today, you are safe. But what if you lose a job in a recession? What if your business loses 30% of revenue? What if your investments drop 40% and you need to liquidate to cover expenses? Leverage that seems comfortable in good times turns into noose in bad times. Consequence of maintaining high leverage? When crisis comes, you will be on the wrong side. It will be a forced seller. It will crystallize losses in the background. You will lose recovery. And you will emerge from the crisis with much less capital than you entered, not because the market destroyed you, but because leverage destroyed you. The sixth protective action is to diversify your holdings geographically in a real way, not just via emerging market ETFs. I'm talking about having physical assets, bank accounts, investments, outside the United States. And I know what you're thinking. This seems extreme. It seems like something for ultra-wealthy people who have tens of millions and need offshore tax planning. But it's not about tax. It's about not having all your eggs in the same geopolitical and monetary basket. Let me give you context. United States represents 23% of the global economy, but 58% of market capitalization. That's a huge discrepancy. It means that American equities are either dramatically overpriced relative to the rest of the world, or the rest of the world is underpriced. Historically, this discrepancy always corrects itself. In 1989, Japanese stocks were 60% of global capitalization. Today, it is 6%. In 2000, U.S. tech stocks were 45% of S&P 500. In 2002, it was 22%. Discrepancies correct themselves, always painfully for those who are focused on the wrong side. Furthermore, the U.S. dollar is at a level of strength that historically precedes weakening. Dollar index is at 105, a level we have only seen 6 times in the last 50 years. Each time it got there, it reversed over the next 12 to 24 months. When the dollar weakens, assets denominated in other currencies perform better for dollar holders. And there is geopolitical risk that Americans underestimate because they have never experienced it. Risk of sanctions, risk of capital controls, risk of confiscation via extraordinary taxes. Sound absurd? Europe imposed wealth tax on Cyprus. Argentina nationalized pension funds. India demonetized 86% of cash in overnight circulation. The chances of something like this happening in the United States are low, very low, but not zero. And when you have the option to diversify geographically without a huge cost, why not do it? Practical implementation. The first step is to open a bank account in a stable jurisdiction outside the United States. Switzerland is obvious but expensive and bureaucratic now. Singapore is excellent for amounts above $500,000. Canada is more accessible and close. Deposit 10 to 15% of your net worth there in local currency or currency mix. Not to evade taxes, you declare everything via F-bar, but to have money available if something happens to the American banking system or if the dollar has a problem. The second step is to buy property or tangible assets in jurisdictions that you consider safe havens. Portugal, Uruguay, New Zealand are popular. Even if it's a small apartment, in addition to agricultural land, you have something that is not denominated in dollars, is not subject to American policies, and can be a refuge if geopolitics gets really bad. Third step is to have a portion of your equity portfolio in companies listed outside the United States, but purchased via ADRs or directly on exchanges. Nestlé, LVMH, Samsung, TSMC, large quality companies that generate cash flows in euros, Swiss francs, won, Taiwan dollars. If the dollar weakens by 20%, these holdings automatically rise by 20% in dollar terms, even if the price in local currency remains flat. Critical warning: geographic diversification is not about renouncing citizenship or becoming a prepper expecting civilizational collapse. It's about having optionality. It's about not having all your capital subject to the decisions of a government, a central bank, a legal system. History shows that total geographic concentration is risky in the long term. Empires fall, currencies collapse, systems change. Having 15, 20, 25% outside your country of residence is prudent diversification, not paranoia. Consequence of not doing this? If the dollar enters a severe bear market, you will see the purchasing power of your equity evaporate. If there are temporary capital controls in a severe crisis, You may be unable to move money when you need it most. And if there is a dramatic political change that affects property rights or taxation, you have no escape valve. The seventh and final action is to create systematic rebalancing discipline based on volatility spikes, not on calendar. Most investors rebalance once a year, or when they remember, or never. This is insufficient. Let me explain to you why. Volatility is mean reverting. When VIX rises from 15 to 40, it historically reverses to 25 to 30 over the next 3 to 6 months. When it rises to 80, like in 2008, it reverts to 40 in the next 6 to 9 months. This creates opportunity. When spike volatility happens, risky assets generally overshoot downwards. Panic dominates. Forced selling dominates. Prices go below fair value. If you have the discipline to rebalance at this moment, you are buying low. You are buying when everyone else is selling out of panic or necessity. 3 to 6 months later, when volatility normalizes, those assets you bought low are substantially higher. You capture mean reversal of both volatility and price. At Bridgewater, we've developed a simple rule. When VX rises more than 50% in less than 10 trading days, we rebalance portfolio for target allocations. We don't try to match the exact background. We just rebalance as soon as the trigger happens. This forced us to buy in October 2008, February 2009, March 2020, September 2022. Not all of them were perfect timing. October 2008, for example, we bought, and the market fell another 28% afterwards. But it doesn't matter. In the 3 to 6 months following each of these rebalances, the portfolio performed significantly above the benchmark because we bought when there was blood in the streets. Practical implementation. Define your target allocations. Example: 40% equities, 25% long-duration treasuries, 15% gold, 10% commodities, 10% cash. It doesn't matter exactly what percentages, it matters that you have clear targets. Set up an alert in your brokerage or use free tools like Yahoo Finance to notify you when VX crosses 35. When notification comes, you have 72 hours to perform full rebalance. Sell what rose above target. Buy what fell below target. Ignore emotion. Ignore news. Ignore fear. Just perform it mechanically. Do this no more than 2 or 3 times a year. Not every month, not every week. Just when spike volatility happens. A common mistake is to rebalance too often. Every time something moves 5–10%. This generates transaction costs and does not capture extreme movements. Or the opposite mistake, never rebalancing because it always seems scary to buy when everything is falling. But it's exactly when it's scary that the opportunity is greatest. In March 2020, when the COVID crash happened and the VX went to 82, it seemed like the world was ending. Those who had the discipline to rebalance bought S&P in 2030. 3 months later, it was at 3,200, a gain of 39%. 6 months later, it was at 3,500, a gain of 52%. Those who didn't rebalance because they were too scared ended up in cash and lost all that recovery. Consequence of not having rebalancing discipline? You will drift to overweight on whatever is performing well, which is usually what is overpriced, and it will be underweight on what is performing poorly, which is generally what is underpriced. When reversal comes, you will be positioned wrong and will suffer. Systematic rebalancing forces you to sell high, buy low mechanically, removing emotion from the equation. Now, I know exactly what's going through your head right now. You're thinking, this all sounds reasonable, but what if you're wrong? What if these signs don't lead to the crisis in the next 12–18 months? What if the market continues to rise and I lose gains because I reduced exposure and increased protection? This is the first objection, and it is the most common. Let me answer you directly. Yes, I could be wrong about timing. I may be early. Signs may be present for months, even 1 or 2 years before the crisis materializes. It happened before. In 2005 and 2006, there were clear signs of a real estate bubble. I was worried already in 2006, but the market continued to rise until October 2007. Those who acted in 2006 underperformed for 18 months, but then it preserved capital while the majority lost half. So yes, there is a cost to being early. You will underperform in the short term. You will see friends winning while you are protected. You will question whether you did it right. But here's the real question you need to ask yourself. What hurts more? Underperform for 12 to 18 months, or lose 30, 40, 50% of your assets when the crisis comes? Because those are your two options. There is no perfect timing. There is no protection without cost. You choose the cost you are willing to pay. I would rather pay the cost of being early, which is limited and temporary, than pay the cost of being unprepared, which is massive and permanent. The second objection I always hear is, but this time it might be different. Artificial intelligence is changing everything. Productivity will explode. Corporate profits will surprise positively. Fed learned lessons from 2008. Central banks have new tools. And here is the brutal truth. Every generation thinks this time is different. In the 20s, it was radio and electricity that would change everything. In the 60s, it was electronics and aviation. In the 90s, it was the internet. And do you know what happened all those times? Technology has really changed everything in the long run. But in the short term, when excess debt, insane valuations, and speculative euphoria combine, crashes happen regardless of technology. The bubble of the 20s crashed in 29, even with radio and electricity revolutionizing life. Nifty 50 of the 60s and 70s crashed even with wonderful companies. .com crashed in 2000, even though internet was the future. AI is real. It will change everything. But this does not immunize the market against debt cycles. Does not immunize against excess leverage. It does not immunize against sentiment reversal when correlations break. Thinking that this time is different is not analysis. It is hope. And hope is not an investment strategy. The third objection, and this one worries me most, is inaction disguised as prudence. I will wait for clearer signs before acting. I'll wait for the Fed to start cutting interest rates. I will wait for credit spreads to widen further. I'll wait for the next earnings season to see how companies are really performing. This is paralysis. It's normalcy bias telling you that you don't need to act yet because nothing drastically changed yesterday versus today. But crises don't work like that. Crises don't warn. Crises don't send an invitation saying, "Attention, I'm going to start next Tuesday at 9 in the morning. Get ready." Crises happen overnight. Lehman was trading on a Friday. On Monday, it was in bankruptcy. Bear Stearns was investment grade on a Thursday. The following Monday, it was being sold for $2 a share. Silicon Valley Bank had $55 billion in market cap on a Wednesday. The following Friday, he was in receivership. When signs become so clear that even the most conservative person recognizes that they need to act, it is already too late. It already happened. He's already lost 30, 40%. Protection works when you act before you need it, not when you're already on fire. So these three objections, I might be wrong about timing, this time might be different, I'll wait for clearer signals, they're all forms of self-deception that prevent action. And imperfect action now is infinitely better than perfect action too late. You have a binary choice in front of you right now. Option A is to take action over the next 2 to 4 weeks by implementing the 7 actions I gave you. Rebalance for real diversification. Buy physical gold. Build massive cash buffer. Add long duration. Reduce leverage. Diversify geographically. Create rebalance in discipline. Yes, it might be early. Yes, it may underperform for months. But when crisis comes, you are protected. You have optionality. You can not only preserve but multiply capital by buying when others are forced sellers. Option B is to wait. Expect clarity. Wait for certainty. Expect more obvious signs. S. You maintain performance in the coming months, maybe years. You don't suffer ridicule for being early. But when a crisis comes, because it always comes, cycles always complete. You lose 30, 40, 50%. You become a forced seller. You crystallize losses, and it takes 5, 7, 10 years to recover because it started from a much smaller base. There is no option C. There is no such thing as keeping everything as it is and also staying protected. There is no perfect timing. There is no free protection. You choose between weeks of regret for acting early or decades of regret for acting late. If this content alerted you to risks you weren't seeing or gave you a framework to think about protection differently, leave a like now because this helps the algorithm get this message to more people who need to hear it. And if you're not yet subscribed to the channel, subscribe and activate the bell because, in the next videos, I'll break down each of these 7 strategies in much deeper detail. I'll show you exactly how to implement each one step by step. And I'll continue tracking these 5 signals weekly to keep you updated on where we are in the cycle and how much time you have left before the protection window closes. I spent 45 years of my life studying how markets work, how cycles repeat themselves, how the economic machine operates. I navigated the crash of 1987 where I lost, but learned. I browsed .com bubble. I sailed 2008 where Bridgewater made 3.8 positive while the world burned. I navigated the COVID crash of 2020. I've seen fortunes made and destroyed dozens of times. And I can tell you with absolute conviction, based not on opinion, but on 50 years of historical data, that the signs I'm seeing now are as serious as anything I've seen before. You can ignore it. You might think I'm being alarmist. You might think this time is different. You have that right. But when you look back in 3, 5, 7 years, the only question that will matter is whether you had the courage to act when there was still time, or whether you chose the comfort of denial until it was too late. Choose your weeks of discomfort now, or your decades of regret later. Because markets don't care about your feelings, crises don't wait for you to be ready, and debt cycles don't pause because you need more time to decide. The clock is ticking, the lights are flashing, and the window of protection is closing a little more with each passing day.